If I had to look at the gold market today from a scratch, knowing what I know about the recent washout, the quiet positioning underneath the surface, and what usually happens when fear forces good assets into the bargain bin, I would read this whole moment completely differently. Most people think a sharp drop means the story is broken. They see the red candles, they hear the scary headlines, and they assume the smart move is to back away slowly and wait for everything to feel safe again. But that's not really how these moments work. The market does not ring a bell and politely tell you when the panic was mostly mechanical and when the long-term case is still sitting there, almost untouched, waiting for people who can keep their heads. And right now that distinction matters a lot. It is Sunday, April 12th in New York, and comment the day and date you're watching from. And by the way, if you value the way I break this stuff down, support the channel by subscribing and comment John A.G. Best down below. Because what's happening here is not just about one metal going up or down for a few weeks. It's about how money behaves when the world gets jumpy, when policy gets messy, when inflation refuses to fully sit down, and when the crowd starts confusing a forced sale with a broken asset. If you position your thinking correctly, you stop reacting like prey every time the screen flashes red. You start reading the game for what it is, not noise, just the structure sitting underneath everything. And in this video, we're going to walk through exactly why this gold sell-off looked scary, why I don't think the fear tells the whole story, what the biggest players appear to be doing in the background, and how regular people can think about this without making it weird, complicated, or full of jargon. Because finance really doesn't need to sound like a robot swallowed a spreadsheet. Now, one thing I want to make clear right up front. I'm not here to tell you to throw your whole life into one shiny rock and call it a strategy. That would be ridiculous. Gold is not magic, it doesn't pay rent, it doesn't build factories, it doesn't launch software products, and if rates stay higher for longer than the market wants, or if the dollar gets a fresh burst of strength, gold can absolutely stay choppy, frustrating, and deeply annoying for longer than people expect. So let's be adults about it. The point is not blind worship. The point is understanding why an asset can get hit hard in the short term while the long-term logic is still very much alive. Because that is where most people get cooked. They think price action and truth are always the same thing. They are not. Sometimes they line up beautifully. Sometimes price is just a fire alarm in a crowded room, and people start sprinting before they've even checked whether there's smoke. That's the setup we're dealing with here. Based on recently published market updates, gold had a brutal monthly drop not long ago, the steepest monthly fall in many years, while China still kept adding to its official holdings and the broader official sector bid remained in place. That doesn't automatically mean the metal rockets tomorrow morning, but it does tell you the sell-off happened in a market where one of the deepest structural buyers never really left the building. And that's the first thing you need to understand. There's a difference between liquidation and rejection. Liquidation is when people sell because they need cash. Rejection is when people sell because they've changed their mind about the asset itself. Those are not the same thing, and the market loves pretending they are. Think of it like this. Say somebody owns a beautiful house in a good neighborhood. Great bones, new kitchen, no obvious issues. Then life punches them in the face. Job loss, margin call, debt problem, business trouble. They don't list the house because the house suddenly became ugly. They list it because they need money now. Immediately. Same house, same street, same foundation. Different reason. That's how I think about what happened to gold. A whole bunch of people saw the drop and said, well, that settles it, the case is dead. I don't think that follows. Because when markets get stressed, funds don't always sell what they hate. They sell what they can. And gold is extremely sellable. It trades deep. It trades fast. It can raise cash. So when geopolitical stress pushes energy higher, inflation worries get sticky again, and hopes for quick rate cuts get kicked down the road, leveraged money starts feeling the squeeze. Then one bad move turns into two, then two turns into five, then the machine starts coughing up assets just to keep itself standing. And in that kind of environment, winners get sold right alongside losers. Not because the thesis died, because cash became oxygen. That's not theory, by the way. The central bank in the United States literally said in its March statement that inflation remains somewhat elevated and that uncertainty around the outlook is elevated too, with the Middle East hanging over the picture. In plain English, that means the nice, smooth road people were hoping for is not so nice and not so smooth. And when the path gets bumpier, the market stops pricing a fairy tale and starts repricing reality. So gold gets hit. The dollar firms for a bit. Rate expectations wobble. People get nervous, and then the hot takes start flying. See? Gold failed. No. Slow down. What failed, at least for a moment, was the market's comfort level. Now, there's another layer here that matters a lot. The official buyers, the reserve managers, the institutions that don't tweet every 30 seconds. These are the people I watch first. Not because they're perfect, they're not. Not because they always buy the exact bottom, they don't. but because when you want to understand the structural trend, you start by asking who has size, who has patience, and who has motives that extend beyond next Tuesday. And on that front, the picture is pretty interesting. From recent reserve data and central bank research, official gold buying stayed historically strong last year. Global demand pushed past the 5,000-ton neighborhood for the first time. And a recent survey showed that an overwhelming majority of reserve managers still expect central bank gold holdings to rise from here, while many also expect the dollar's share of reserves to drift lower over the next several years. That is not a tiny footnote. That is a giant blinking sign telling you the long-term reserve conversation is still moving in gold's direction. Now, does that mean every central bank is dumping every treasury and backing up the truck on gold? No. Let's not get theatrical. But it does mean the diversification trend is real. And real trends matter more than dramatic headlines. That's especially true when you add China to the story, because China is not only still adding to official gold holdings over a streak that now stretches well beyond a year, there's also that policy channel people keep underestimating. The pilot program that lets a select group of major insurers invest a sliver of their assets in gold is not some cartoonishly huge overnight shock. But it opens a new pipe of potential demand from a pool of money that is absolutely not small. Even a tiny allocation from giant balance sheets can matter over time. And there's a second misunderstanding that showed up during this mess, and it's worth cleaning up because it changes how you read the tape. Sometimes people hear that a country moves some gold and they instantly say, aha, they're dumping it, even sovereigns want out. Maybe, but not always. Sometimes gold gets used the same way highly trusted collateral gets used in any tight funding environment. It gets pledged, it gets swapped, it gets leaned on temporarily because it is one of the few things people still respect when cash is suddenly scarce. In other words, using gold in a funding pinch can actually tell you the asset is trusted, not hated. That doesn't mean every official transaction is bullish. It means you shouldn't lazily label every movement as outright rejection when some of it is just balance sheet plumbing. That distinction matters because markets are full of people who confuse plumbing with philosophy. They see a pipe move and think the whole building changed religions. No, sometimes it's just a pipe. And that's why I keep coming back to the same core idea. Price can tell you something true while still telling you the wrong story if you don't understand the mechanism underneath it. Now let me give you the mistakes I would avoid here, because avoiding stupid pain is just as important as finding opportunity. Mistake number 1 is waiting for the perfect mood. People do this all the time. They say they're interested. They say they understand the long-term case. They say they've been meaning to get exposure. But they only want to do it when the chart looks pretty, the headlines feel calm, and everybody at the dinner table agrees it was obvious all along. Well, congratulations. That's usually the expensive moment. The market rewards courage with discomfort first. That's the cover charge. Mistake number 2 is confusing a hedge with a lottery ticket. Gold is not there to entertain you every day. It is not supposed to act like some hyper-growth stock with fireworks coming out of its ears. Its job in a portfolio is different. Sometimes it sits there quietly for stretches that feel boring enough to make people question their life choices. Then some macro shock hits, some policy mess appears, some confidence crack opens up, and suddenly the boring thing doesn't feel so boring anymore. If you buy it expecting nonstop excitement, you're probably going to get annoyed and do something dumb. Mistake number 3 is pretending miners and metal are the same thing. They are not. Let me say that again because people always blur this. They are not. A mining stock can be a wonderful opportunity, and it can also be a messy little drama club wrapped around a commodity price. Costs matter, jurisdictions matter, management matters, capital discipline matters, execution matters. A miner can get the gold call right and still disappoint you. So if what you want is direct exposure to the metal thesis, don't accidentally load up on a completely different risk package and then act shocked when it behaves differently. Mistake number 4 is making every decision from one chart. Gold chart, dollar chart, real yield chart. You pick. None of them gets the whole job done alone. You have to synthesize. You have to ask what the policy backdrop is doing, what reserve managers are doing, what investor flows are doing, what inflation is doing, what geopolitical stress is doing, and what the market's emotional temperature is doing. It is a mosaic, and people who insist on one variable explanations usually end up sounding very confident right before the market embarrasses them. Mistake number 5 is trying to sound smarter than the market instead of listening to it. There's a difference between skepticism and arrogance. Skepticism says, let me test the story. Arrogance says, I already know the story. I try very hard to stay on the first side of that line, because yes, I think the bigger case for gold is still intact, but I also know the market can stay awkward longer than my ego would enjoy. That humility matters, a lot. And yes, there is a world where gold disappoints for a while anyway. Maybe growth hangs in better than feared. Maybe inflation cools faster. Maybe policy stays restrictive enough to keep pressure on non-yielding assets. Maybe the dollar catches another bid. All possible. But that world still has to wrestle with the same long-term reserve questions, the same debt questions, the same trust questions, and the same diversification instincts that have been building for years. That's why I think the real debate is less about whether gold can wobble, because obviously it can, and more about whether the reasons people keep circling back to it have actually weakened in a durable way. And when I look around, I don't see durable weakening. I see noise on top of persistence. And this is where I think people miss the plot. They hear up to 1% and shrug. 1% sounds tiny when you say it fast, but 1% of something enormous is still enormous. Insurance money is slow money, methodical money, committee money. It doesn't run around the room screaming every time a chart has a bad week. It usually moves in a much more deliberate way. So when a door opens for that kind of capital to buy gold, you don't laugh because the percentage sounds small. You ask what that means over a multi-year horizon if confidence in other assets stays shaky. That's the game. Not tomorrow morning, not by lunch. Over time. And that brings me to something else the crowd keeps getting backwards. People love saying gold only works if the central bank starts slashing rates fast, and the dollar falls in a straight line and everything lines up perfectly. I don't buy that. Could lower rates help? Of course. Could a weaker dollar help? Absolutely. Could both happen together and light a fire under the market? Sure. But gold's role is bigger than one tidy macro checklist. Gold tends to matter most when confidence gets messy. Not just when rates do one specific thing. Not just when inflation prints one convenient number. It matters when trust in the broader setup starts fraying at the edges. And tell me honestly, does this look like a world overflowing with clean trust? We've got governments running deficits that still look bloated. We've got geopolitical fractures that can turn an energy chart into a horror movie overnight. We've got central banks still trying to balance inflation, growth, employment, and political pressure without stepping on a landmine. We've got investors who spent years being trained to buy every dip in risk assets now having to relearn what discomfort feels like. That environment doesn't make gold irrelevant. It keeps gold in the conversation. Now, I also want to challenge something implied by the bullish crowd, because this matters too. A lot of people act like once a few big institutions lean positive on gold, that's game over. Thesis confirmed. Everybody go home. No. That's lazy thinking. Institutional optimism is useful. It is not a guarantee. Big players can be directionally right and early. They can be right on the long-term structure and wrong on the next quarter. They can also all agree on a story and still watch the market punish everyone before rewarding anyone. So don't take smart money as interested to mean there can't be another nasty drawdown. There can. There probably will be. This thing can absolutely swing. It can absolutely fake people out. It can absolutely throw a tantrum right when the narrative feels strongest. That's part of the asset. If you can't emotionally tolerate volatility, the market will collect your lunch money on a schedule. Which is why I think the better question is not, can gold go down again? Of course it can. The better question is, has the structural reason for owning some exposure actually disappeared? And when I look at the puzzle pieces, I don't think it has. In fact, the newer data makes the background feel even more important. According to the latest publicly available filings and industry research, last year was not just some decent year for gold demand. It was a monster year. Demand pushed into record territory. Exchange-traded funds had one of their strongest years on record. Bar and coin buying stayed strong. Official buyers remained active even with prices already high. That is not what a dead market looks like. Dead markets do not attract that kind of broad participation. And yet, because we had a nasty drop, people suddenly want to pretend the whole thing was a mirage. I don't think that's serious. I think that's emotional. There's a difference. Let me simplify the whole framework. I think there are three things you watch. First, what are the biggest and most patient players doing? Second, what is the crowd doing emotionally right now? Third, what is the long-term structural wind doing? Even if the weekly chart looks like it got hit by a truck? Start with the big players. Official buying remains a thing. Reserve diversification remains a thing. Insurance demand in China now has a fresh channel, and a lot of serious forecasters stayed constructive even after the pullback, with some of them pushing their longer-term targets higher earlier this year, as investment demand surprised to the upside. Again, that doesn't give you certainty, but it tells you the people with giant research teams didn't look at one ugly sell-off and suddenly decide the whole case evaporated. Then look at the crowd. The crowd is usually most dramatic near the emotional extremes. At tops, the crowd thinks risk no longer exists. At bottoms, the crowd thinks risk is the only thing that exists. And after a fast sell-off, especially one tied to geopolitics and sticky inflation fears, the crowd tends to lose its mind a little bit. That's normal. Not flattering, but normal. People start saying they'll wait for clarity, they'll wait for calm, they'll wait until the move is obvious. But here's the problem. By the time the move feels obvious, a chunk of it is often already gone. That doesn't mean you rush in blindly. It means you stop demanding emotional comfort as the price of admission, because the market charges a premium for comfort, always. Then the structural trend. This is the big one, and it's the one that matters most if you're not day trading every wiggle. The structural trend says the world is not moving toward less uncertainty. It says reserve managers still want diversification. It says the dollar may remain dominant. Yes, but the conversation around over-reliance on it is not going away. It says fiscal stress, political friction, supply shocks, and cross-border tension are not exactly disappearing from human civilization next quarter. That is the backdrop. And gold lives in that backdrop, not because it is perfect, because it is simple. No earnings call, no chief executive, no credit committee, no promise from a government that can get rewritten in a panic. That simplicity matters more than people think. One more thing here because I know somebody's already typing it. What about cash? Look, cash is useful. Bills need to get paid. Emergencies are real. Dry powder matters. I am not one of these maniacs who tells people to hold zero cash and live like a pirate. But the idea that sitting in cash for ages is some masterstroke while inflation remains sticky and policy uncertainty stays high, I don't love that logic. Especially if you're waiting for some magical all-clear signal that may never arrive in the clean form you imagine. And if you're successful, share your success story in the comments so others can stay motivated. Because what destroys people in markets is often not one terrible decision. It's endless hesitation. Death by maybe. Death by, I'll do it later. Death by, I'm waiting for better conditions. Meanwhile, the world keeps moving. The structure keeps evolving. The big players keep reallocating. And the crowd keeps reacting late. Now, I want to talk about the recent rebound too, because that adds an important wrinkle. When tensions cooled a bit and the dollar softened, gold bounced hard and ran back toward a multi-week high. That matters because it showed how quickly the metal can recover once the inflation panic eases a touch, and the market starts reopening the door to easier policy down the line. But even there, I wouldn't get carried away. A rebound is not the same as resolution. The geopolitical backdrop is still fragile, and one headline can flip sentiment again in a heartbeat. So no, I'm not telling you this is some straight staircase. I'm telling you the market is signaling that when pressure lifts, gold still has plenty of people willing to step back in. That's different, and it matters. So what would I actually do with all this if I were trying to think clearly? I'd stop obsessing over the last scary month as if it tells the whole truth. I'd stop treating every violent decline like a confession from the market that the thesis was fake. I'd stop worshiping precision, and I'd start building a process, a boring, repeatable, adult process. Something like this. Step 1, decide whether gold is something you want as a trade, a hedge, or a long-term store of optionality. Those are different jobs. Don't mix them up. If it's a trade, you care more about timing, levels, and volatility. If it's a hedge, you care more about what else is in your portfolio. If it's a long-term store of optionality, you care more about structural reasons and less about whether next month is pretty. Step 2, decide the size before emotion gets involved. Because if you wait until the market is puking, your brain will turn into mashed potatoes. Sizing is everything. A sensible position can survive volatility. An oversized position turns normal volatility into emotional warfare. Step 3, understand the vehicle. Physical metal is one thing. Funds are another. Mining stocks are another beast entirely. They are not interchangeable. People talk about them like they're cousins at the same barbecue. They are not. One gives you direct exposure. One gives you market convenience. One gives you operational risk, management risk, political risk, cost risk, and all the rest of the circus. Know what you own. Step 4, accept that no single chart tells the whole story. You watch the dollar, you watch rate expectations, you watch official buying, you watch geopolitical stress, you watch investor flows, and then you hold all of that together without turning into a lunatic every afternoon. That's the skill, not prediction, process. Now let's talk about the bear case for a second, because it's fair. The bear case says inflation could stay annoying enough to keep rates elevated. The dollar could stay firmer than expected, risk assets could stabilize, geopolitical fear could cool down, and some of the urgency around safe havens could fade. That is a real case. I'm not ignoring it. But even inside that case, you still have official diversification, you still have reserve managers thinking beyond one cycle, and you still have a world that does not exactly scream monetary innocence. So even the bear case, to me, looks more like an argument for chop and frustration than a clean obituary. That's important. Because a lot of people think in binaries, moon or doom, boom or bust, hero or clown. Reality is usually messier, and messier is where process wins. One of the sneakiest mistakes investors make is assuming that if an asset is fundamentally attractive, the path has to be smooth. Nope. Sometimes the better the long-term logic, the nastier the short-term traps. Because the market's job is to test conviction before rewarding it. That's just how it goes. And gold especially has a way of humbling both the tourists and the zealots. The tourists bail at the first ugly shakeout. The zealots think nothing can ever go wrong. Both get smacked. The sweet spot is somewhere in the middle. Respect the volatility. Respect the structure. Don't turn it into religion. Don't turn it into a joke either. Now, I want to add one last layer that I think is underappreciated. Trust. Not just inflation. Not just rates. Trust. Gold tends to do its best work when trust in the surrounding architecture starts thinning out. That can be trust in fiscal discipline, trust in policy timing, trust in geopolitical stability, trust in the idea that fiat purchasing power will be managed cleanly and responsibly over long stretches of time. And right now, I think trust is a little bruised. Maybe more than a little. You can see it in reserve behavior, you can see it in diversification flows, you can see it in how quickly investors rush back to hard assets when the macro story gets ugly. And that's why I keep coming back to the same conclusion. This recent smash lower looked more like a stress event than a death certificate. It looked more like funds grabbing cash than the world suddenly deciding gold no longer mattered. It looked more like a reset in positioning than a reset in purpose. And those are very different things. So when I step back from the noise, here's what I see. I see a market that got hit hard. I see plenty of emotional damage. I see a backdrop where inflation is not fully solved, policy is not fully clear, and geopolitics is absolutely not fully calm. I see official buyers still involved. I see a new institutional demand channel in China. I see reserve managers around the world still viewing gold favorably. I see investors who got reminded that safe haven does not mean no volatility. And I see a crowd that may still be underestimating how often the best long-term setups come wrapped in very ugly short-term packaging. That is the picture. So no, I don't think every dip means buy with both hands and start doing cartwheels in the driveway. But I also do not think this was the kind of move that should scare thoughtful people away from the entire case. Not even close. If anything, it should force a better question. Not did gold go down? Obviously it did. The better question is why did it go down? Who kept buying anyway? And what does that tell me about the bigger reset happening underneath the surface? That's the real conversation. And that's the one most people never have. Because they get trapped staring at the red candles like they contain all the wisdom in the universe. They don't. Sometimes a sell-off is information. Sometimes it's just stress. Your job is learning the difference. And if you're one of the people who can learn that difference, who can keep emotion in the passenger seat instead of letting it drive the car into a lake, you give yourself a real shot at staying on the right side of the next move. Maybe that move is fast. Maybe it's delayed. Maybe it comes in waves. I don't know. Nobody honest knows. But I do know this. When the world keeps handing us deficits, uncertainty, reserve diversification, fragile confidence, and sudden liquidity spasms, gold doesn't stop mattering just because it had a terrible month. Usually that's when it matters most. So tell me this in the comments. Do you think the crowd is still misreading this drop? Or do you think the real pain for gold is still ahead? And one final thing. Everything I've shared here is for educational purposes, so you can think more clearly, ask better questions, and make more informed decisions. It's not personal financial advice, it's not a command to buy or sell anything, and you should always weigh your own goals, risk tolerance, and time horizon before making any move with real money.